Okay, let's run a quick mental experiment to kick things off today. Imagine you are walking into a local convenience store, right? You wander down the aisle, and sitting right there on the shelf is a crisp, totally valid $20 bill. But the price tag directly below it says $8.50.
I mean, I am buying the entire shelf. I'm emptying the register to buy as many of those as I can.
Right. That is the purely rational reaction. But then your brain actually kicks in. The skepticism creeps up. You hesitate. You start thinking, what's the catch? Is it counterfeit? Is it torn in half on the back? Is the store currently on fire? And I just haven't smelled the smoke yet.
Or, and this is the really interesting part, is the market just temporarily blind to what it is actually looking at?
Yes. That is the exact multi-billion-dollar question we are wrestling with today. We are looking at MRA Holdings. Now, most of you probably know them as Marathon Digital, the massive Bitcoin mining giant. But right now, as we sit here recording this on February 27, 2026, the stock is trading at roughly $8.57.
Which is, frankly, historically low for them, especially when you consider where they have been in previous market cycles.
It really is. But here is where it gets weird. We have a huge stack of documents in front of us, earnings reports, analyst notes, and this very dense intrinsic valuation report titled Digital Asset Infrastructure and the Pivot to AI. And when you run the math on that model, the complex stuff that tells you what a business is actually worth based on its future cash flows, it says this stock should be trading at nearly $24.
Yeah, that is a massive disconnect. We aren't talking about a 5 or 10% arbitrage opportunity here. We are talking about a potential 64% discount sitting right there in plain sight.
So the mission for this deep dive is pretty simple, but the stakes are incredibly high. Is MRA what Wall Street calls a value trap? Like, basically a sinking ship that looks cheap simply because it's dying? Or is this the sale of the decade?
To answer that, you can't just look at the Bitcoin price ticker anymore. You really have to look at the date. It's 2026. The entire game has changed. MRA isn't just trying to mine crypto anymore. They are attempting this massive, incredibly expensive pivot to become a digital infrastructure giant. They basically want to power the AI revolution.
But pivots are messy. They burn a ton of cash. And with the global tariffs kicking in this year, the headwinds are very real.
It's the classic corporate dilemma, really. Can they survive the transition? Our goal today is to figure out if MRA is still just a levered bet on Bitcoin, or if it has evolved into a legitimate, undeniable energy utility for the AI age.
I am naturally skeptical, but I'm ready to be convinced. Let's get into the sources. Part 1, Chapters 1 to 3, Business, Management, and Financials.
I am ready when you are.
Chapter 1, Business Understanding.
Let's start with the identity crisis. Or I guess identity evolution is maybe the more polite term for it.
Yeah, we have known them as Marathon Digital for years, ticker symbol MARA. But the company is now officially MRA Holdings. Is this just corporate marketing fluff to sound fancy to institutional investors, or does it actually mean something fundamentally?
It sounds like a subtle tweak, right? Like when Facebook became Meta or Google became Alphabet.
Yeah.
But in this specific case, it signals a massive shift in their business philosophy. For the last 5 years, Wall Street pegged them strictly as a pure-play Bitcoin miner. The algorithm was incredibly simple. If Bitcoin went up, MRA went up.
And if Bitcoin crashed, MRA crashed harder.
Exactly. They were essentially a leveraged ETF that you could just buy on the NASDAQ.
Which makes sense. I mean, that was the business. You plug in machines, you solve complex math problems, you get Bitcoin.
It was. But this new report highlights a phrase that keeps popping up in their internal docs and their recent investor calls, and that phrase is maximizing every megawatt.
Maximizing every megawatt. Let's unpack that a bit.
So the leadership realized something critical about the digital economy as we move deeper into 2026. Look at computer chips, right?
Yeah.
GPUs, ASICs. Yes, they are very expensive right now, but ultimately they are becoming commodities. We can always build factories to make more chips. Intel can build a fab, TSMC can build a fab, but energy, specifically the kind of massive, consistent baseload power required for blockchain security and AI inference, that is the real scarcity.
Because you can't just print more electricity infrastructure overnight.
Exactly. It takes years, sometimes decades, to build new power plants and transmission lines. So MRA is flipping the script. They're saying, hey, we aren't a crypto company that consumes electricity. We are an energy company that monetizes that energy through digital assets.
That is a fascinating thesis. They view themselves as energy managers first. The Bitcoin mining is just one way to turn that energy into money. AI is another avenue.
Spot on.
Okay, so let's talk scale. Because whenever I read about MRA in these reports, the numbers just seem, I don't know, abstractly large? Help us visualize what kind of operation they're actually running day to day.
They are the absolute gorilla in the room. There's no other way to put it.
Yeah.
As of late 2025, they are operating a global network of 13 massive data centers. And inside those centers, they have roughly 265,000 Bitcoin miners active right now.
265,000. I'm trying to even picture that. That is not a server room in the basement of an office building. That is a small city of machines.
It is an army. If you line them up, the server racks would stretch for miles. And that fleet controls over 5% of the total global Bitcoin network hash power. Just think about the implications of that for a second. One single publicly traded company controls 1/20th of the security for the entire decentralized Bitcoin network.
That's wild. I saw in the report that the energized hash rate is sitting at 66.4 exahashes per second. Now, for the non-technical listener, an exahash sounds like some sort of sci-fi weapon. Put that in context for us.
It does sound like something straight out of Star Trek.
Yeah.
An exahash is a quintillion hashes per second. That is a number with 18 zeros behind it.
Wow.
Yeah. To put it simply, it is a staggering, almost incomprehensible amount of raw computational force. And that number is up 25% year over year. So despite this AI pivot we are about to discuss, they are not slowing down on the mining side at all. They're getting bigger and faster.
Okay, so the mining base is solid. It is massive. But the stock isn't down at $8 because of mining. The stock is down because the market is really unsure about this shiny new object, the AI pivot. We hear literally every company talking about AI in 2026. It feels like buzzword bingo half the time. What is MRA actually doing in this space?
This is where that digital infrastructure label really comes in. They have launched a major partnership with Starwood Digital Ventures. The goal here is incredibly ambitious. They're targeting 1 gigawatt of capacity with a long-term roadmap to scale that up to 2.5 gigawatts.
2.5 gigawatts. I have to make the joke that is literally Back to the Future levels of power.
It is actually double what Doc Brown needed. It is enough electricity to power a major American city. But their strategy isn't just to build a big traditional power plant. It is a modular approach.
Explain modular in this context. Why is that a better strategy?
Usually, if you want to build a data center, you find a spot, you apply for a grid connection, and you wait maybe 5 years for the utility company to string the lines and upgrade the transformers. MRA is saying, no, we aren't waiting for the grid to come to us. They are taking the compute infrastructure, the servers, the cooling systems, and dropping it directly at the source of the power generation.
So they are bringing the mountain to Muhammad, essentially, bringing the computers to the energy source rather than moving the energy across the country to the computers.
Exactly. And this is where the integration gets really clever. They use the same power source for two completely different things. They use the Bitcoin mining for grid balancing.
Grid balancing, how does that work?
Think of the mining operation as a massive sponge. When there is too much power on the grid, say, the wind is blowing really hard in West Texas at 3 a.m. and nobody is running their air conditioning power, prices actually go negative. MRA turns on miners and soaks up all that cheap power to make Bitcoin. But when demand spikes, like during a heat wave at 5 p.m. when everyone gets home, they can shut down the miners instantly to free up power for the regular grid.
Okay, so the mining is like a battery. It is flexible. You can just turn it off with a switch.
Correct. But AI is a totally different beast. You cannot turn off ChatGPT just because electricity got expensive for an hour. You cannot turn off a hospital's AI diagnostic system. AI needs uptime. It requires 99.9% reliability.
So how does MRA handle that? If they were used to being this flexible sponge, how do they suddenly become an unbreakable pillar?
That is the exact execution risk we need to highlight today. They are trying to use that same infrastructure backbone to support AI inference. They are betting that their deep expertise in cooling and power management naturally translates over. But running a crypto mine and running a Tier 4 AI data center are very, very different disciplines. One is essentially a warehouse where you don't really care if a machine goes offline for 10 minutes. The other is a pristine laboratory where uptime is absolutely everything.
That is a key distinction. Now, they aren't the only ones trying to solve this puzzle. We have got Riot Platforms, we have got CleanSpark. How does MRA stack up against the competition in this space? Are they winning?
It is a bit of a mixed bag, honestly. If you look purely at growth percentages, MRA is actually lagging a bit. Their revenue growth is 53.5%.
Which, I mean, in any normal industry, 53% would be a miracle year.
Right. In traditional tech, 50% growth is a banner year that gets you on the cover of magazines. But then you look at Riot Platforms, and they are growing at over 100%. Clean spark is moving incredibly fast too.
So why is MRA slower? Is it simply because they are already so much bigger?
It is the law of large numbers. It is significantly harder to double your size when you are already a giant. But MRA has a moat, a competitive advantage, that the others are really struggling to match. It comes down to a concept called energy optionality.
Energy optionality. That sounds like perfect MBA speak. Break that down for us.
It means they don't just buy power from the grid. They own the relationship with the actual power generation. They have a massive partnership with MPLX. They actually own wind farms and flare gas sites in Texas.
So they aren't just a tenant renting space from the electric company. They are, in some cases, the landlord.
Or at least the primary partner. They have steadily moved from a hosting model where you pay someone else a fee to run your machines to an ownership model. About 70% of their sites are now fully owned and operated by MRA.
Why does that matter so much for the bottom line?
Control. When you host, you are completely at the mercy of the operator's pricing and efficiency. When you own the site, you control the costs. You can install your own proprietary tech. For example, MARA is heavily into liquid immersion cooling.
Oh, I have seen pictures of this online. It looks like the computers are submerged in these giant fish tanks full of oil.
It looks totally wild, but it is incredibly efficient. The dielectric fluid removes heat way better than traditional fans. That means you can overclock the machines, run them much faster than factory settings without burning them out. And you don't need these massive power-hungry air conditioning units blowing cold air through a warehouse. It fundamentally lowers the cost per coin produced.
So, to summarize the business side, we have a massive incumbent, the biggest in the game, pivoting from being a pure Bitcoin miner to an energy infrastructure company. They own their sites, they have unique tech, but they are growing slower than their smaller rivals. Which naturally brings us to the people actually making these decisions. Because you can have the best machines in the world, but if the captain is asleep at the wheel, you are hitting the iceberg. Chapter 2, Management Evaluation.
I always think of that famous Warren Buffett line, when you buy a stock, you buy the management. Who is actually steering the ship at MARA right now?
You have the chairman and CEO, Frederick G. Thiel, and the CFO, Salman Khan. And I think it is important to note right off the bat, as you read through their transcripts, these aren't your typical crypto bros. You don't see them on Twitter posting memes with laser eyes or promising the moon.
No, have fun, stay in core tweets.
Not from this C-suite. They frame MARA very deliberately as an operating company.
I noticed that in the notes too. They seem really sensitive about that specific phrasing. They really push back against the idea that MARA is just a passive wallet holding Bitcoin.
They absolutely hate that comparison. They were trying to tell Wall Street, look, judge us on our cash flow, judge us on our infrastructure and our energy assets. Do not just look at the price of Bitcoin today and peg our stock to it.
But, and there's a really big but, here investors aren't fully buying that narrative yet, are they?
No. There is a definite trust gap right now, and it really comes down to transparency regarding the actual cost of this AI pivot. We talked about how hard it is to build these AI data centers. Well, it is also incredibly expensive, and institutional investors are asking, where exactly is the money going, and when will we realistically see the return on that capital?
And the stock price reflects that deep uncertainty. The volatility is just nauseating. The intrinsic valuation report mentions a beta of 5.53.
Yeah, that number made my eyes water a little bit.
For the listener who maybe doesn't track beta normally, a beta of 1.0 means the stock moves exactly in tandem with the S&P 500. If the broader market goes up 1%, your stock goes up 1%.
And a beta of 5.5 means you are basically strapped to a rocket. If the market drops 1%, MARA might drop 5 or 6%. If the market has a generally bad week, MARA gets absolutely slaughtered. It makes the stock a nightmare to manage if you are a portfolio manager looking for stability.
So the management clearly has this massive volatility problem. They need to calm people down and show maturity. What are they actively doing to smooth things out?
They're being surprisingly aggressive with mergers and acquisitions. They recently acquired a majority stake in a company called Exaon that instantly gets them into secure cloud inference, basically buying the specific AI expertise they didn't naturally have in-house. They also bought a minority stake in 2Prime to get better yield on their existing treasury assets.
But then there is the move that really had me scratching my head when I read the report. And honestly, it feels a bit contradictory to everything else. Right in the middle of all this massive cash burn, trying to build data centers and buy expensive chips, they declared a dividend.
Yeah. 42 cents a share, payable in March 2026.
Why? I mean, why pay a cash dividend when you have deeply negative cash flow. It feels like taking money out of your savings account to buy your friends a fancy dinner when you don't currently have a job.
It is a total head scratcher if you look at it purely through a traditional financial lens, but you really have to look at it
So
psychologically.
it is a mind game.
It is a signal. Management is essentially trying to say, look, we are so confident in our long-term stability and our massive Bitcoin treasury that we can afford to return capital to you right now. They are trying to attract an entirely different class of investor. They want the income investors. They want the people who usually wouldn't touch a crypto stock with a 10-foot pole because it doesn't pay a yield.
That is a bold strategy, sort of a fake it till you make it, or maybe project strengths to build strength kind of vibe.
It is definitely projecting strength.
Yeah.
But it pairs with another move that is equally aggressive, maybe even more so, the debt. They issued $1 billion in convertible notes with 0% interest.
0%. Who lends $1 billion at 0% in this macro economy?
Sophisticated arbitrage traders and hedge funds. Lenders gave them $1 billion for free, essentially, with the option to convert that debt into MRA stock later if the price goes up. And MRA took that $1 billion and did what with it?
Let me guess. They just bought more Bitcoin.
They bought a ton more Bitcoin and retired some old, more expensive debt. It is highly, highly leveraged. They are essentially betting the farm that Bitcoin goes up significantly, because if Bitcoin crashes, that 0% debt still has to be paid back, and it becomes a very heavy anchor.
So we have a management team that acts like a responsible dividend-paying utility company during the day. Look at our infrastructure, look at our yield. But at night, they were making massive leveraged bets on crypto volatility.
That is the duality of MARA right there. And that duality shows up so clearly when we actually open the financial books. Chapter 3, Financial Health.
Okay, we have teased the numbers enough. Let's look at the actual balance sheet. And honestly, depending on exactly where you look, it is a tale of two cities. It is the best of times, it is the worst of times.
It really is. Let's start with the ugly numbers because they are staggering and they are what dominate the headlines. In Q4 of 2025, MRA reported a net loss of $1.7 billion.
Billion, with a B. That is a number that usually signals immediate bankruptcy for a company of this size.
It does. And this is critical for anyone reading these reports. We have to unpack that number. If you just read the headline, you panic and sell. But the vast majority of that $1.5 billion, to be exact, was a markdown on their Bitcoin holdings due to fair value accounting rules.
Okay, explain that simply for us, because accounting rules can hide a lot of sins, or in this case, make things look worse than they are.
Basically, the accounting rules say that if the price of Bitcoin drops during the quarter, MARA has to report that drop as a loss on paper, even if they didn't sell a single Bitcoin.
So if I own a house and the local real estate market dips for a month, I don't technically lose money unless I panic and sell the house. But MRA has to report it as a loss immediately on their quarterly earnings.
Exactly. It is entirely a paper loss. It doesn't mean cash actually left the corporate bank account. It just means the asset value dipped on that specific reporting day.
Okay, that makes me feel slightly better about the $1.7 billion. But what about the actual cost of running the business? The real cash leaving the bank every day?
That is where the real undeniable concern lies. Forget the paper loss for a second. Their operating margin is negative 68%.
Ouch. So for every dollar of value they create mining, they are spending $1.68.
Roughly, yes. It costs them significantly more to run the machines, pay for the power, and depreciate the equipment than they are generating in immediate operational profit. This is partly due to high energy costs, but also because mining rigs depreciate incredibly fast. A top-of-the-line miner today is practically a paperweight in 3 years.
That is a brutal treadmill to be on. You have to keep buying new, expensive machines just to stay in the exact same place regarding hash power.
And that reality showed up clearly in the free cash flow. Negative $1.77 billion over the last 12 months. They are burning cash to grow. They are building new data centers. They are buying AI chips. They are buying more Bitcoin. They are in full aggressive expansion mode.
So that's the ugly. They're basically burning the furniture to keep the house warm while they build an addition. But they are still in business, so there must be some good numbers keeping the lights on.
There are. Revenue is actually at a record high. Full year 2025 revenue hit $907.1 million, which is up 38%. So the money is coming in the door. It's just going out even faster.
And we can't forget the piggy bank, the treasury.
The fortress. This is what saves them and lets them sleep at night. They hold roughly 53,822 Bitcoin. They are the second largest public holder of Bitcoin in the world.
That is their ultimate insurance policy. If push really comes to shove and the debt comes due, they can just sell a chunk of that Bitcoin to keep the lights on.
Exactly. It gives them a financial runway that other infrastructure companies simply don't have, and their overall liquidity is okay. Their current ratio is 2.09,
Meaning.
meaning they have about $2 in liquid assets cash or crypto they can instantly sell for every $1 of bills due in the next 12 months. So bankruptcy isn't knocking on the door tomorrow, despite that massive burn rate. They have time to figure this out.
Now let's circle back to that valuation model we mentioned in the intro,
Yeah.
the $24 price target. How did the math wizards get there if the company is currently losing billions on paper and burning cash?
This is a great educational moment for the listeners. If you look at the PE ratio, price to earnings, it looks deceptively low, hovering around 3.4 to 4.7. Usually a low PE means a stock is cheap. But here it is completely useless because of those weird fair value accounting rules we just talked about skewing the earnings.
So you just throw out the PE ratio entirely.
Throw it out. You have to use a DCF, a discounted cash flow model. The report we are analyzing makes some very specific assumptions to build this. It assumes a steady 15% annual growth rate, but the really big assumption is that MRA turns cash flow positive in 2026.
That is the massive pivot point.
Yes. The model assumes they cross the threshold and generate about $146 million in positive cash flow next year.
And it is a massive, highly debated if, that holds true.
Then the intrinsic value of the business comes out to $23.73 per share.
So if management can stop the operational bleeding, successfully execute the AI pivot, and just maintain the treasury, the market is pricing this stock wrong by an absolute mile right now.
Correct. But currently, the market is aggressively pricing in the fear that they can't stop the bleeding.
Which leads us perfectly into the market mood. What are the day traders and institutional investors actually thinking right now?
Part 2. Chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment.
Welcome back to Part 2. We have looked at the massive machinery, the management's dual personality, and the somewhat confusing financials. Now let's look at the overall mood. What is the vibe on Wall Street regarding MARA right now?
In a word, gloomy. The mood is heavily dominated by that Q4 earnings miss we talked about.
Yeah.
The media tone across the financial networks is very cautious. They are worried about the stock's volatility, they're worried about rising energy costs, and frankly, I think analysts are just tired of the unpredictability.
It feels like the market has firmly entered a show-me phase. They are done listening to glossy presentations about AI. They want to see actual paying enterprise clients and real profits.
That's exactly it. They want receipts. But beneath the surface, you have this fascinating, almost violent battle between the bulls and the bears. The bulls are fixated on one specific metric, Bitcoin per share. In 2025, MRA increased their Bitcoin per share by almost 108%.
Meaning, for every single share of MRA stock I own, the underlying amount of Bitcoin backing that share more than doubled in a year?
Yes, and to a true bull, that is the only metric that actually matters. They see MRA as a tax-advantaged, leveraged way to hoard Bitcoin. They honestly do not care about the operational losses as long as that physical stack of Bitcoin keeps growing.
But the bears, how are they countering that?
The bears look at those negative 68% margins and say, this is a furnace burning money. They see the potential dilution from the convertible debt, they see the energy costs rising, and they think the AI pivot is a desperate distraction.
And what are the professional analysts saying? The people actively paid to give a rating.
Interestingly, the consensus is still a moderate buy. Their average price target is $21. So even Wall Street, the traditionally cautious, suit-wearing Wall Street, thinks the stock should be more than double what it is trading at today.
Let's look at the chart for a second. For the technical analysis nerds out there, is the chart looking healthy?
No, the chart is technically broken. The price is at $857. That is well below the 50-day moving average of $938 and way, way below the 200-day average of $1358. In classic technical terms, this is a confirmed downtrend. It is falling.
But there is a twist. I feel like there is always a dramatic twist with this specific stock.
There is a massive twist. Short interest.
30.7% of the float is sold short.
That is an incredibly high number. Nearly 1/3 of all the available shares for trading have been bet against. People are actively borrowing shares to sell them, hoping the price drops further so they can buy them back cheaper.
But this creates a very dangerous setup for those short sellers, right? A springboard effect.
A massive springboard. We call it a short squeeze. If MARA releases just one piece of genuinely good, unexpected news, maybe the Starwood AI deal expands faster than expected, or Bitcoin suddenly jumps 10%. All those short sellers have to panic buy to close their positions and stop their losses. And when you have to buy back 114 million shares all at once,
The price goes completely vertical.
exactly, it creates a vacuum of buy orders. It is a very crowded trade on the negative side right now, which paradoxically makes the upside potential explosive. Everyone is leaning on the exact same side of the boat. If the boat tips even a little bit, they all fall in.
Chapter 5. Ownership structure.
So who is actually holding the bag right now? Who owns this company?
It is not just retail traders on Reddit, which is what a lot of people assume with crypto stocks. This is the fascinating part. 66.5% of the company is owned by institutions.
The big boys.
The biggest. BlackRock owns 15.5%. Vanguard owns 12.3%.
So wait, if the financials are so incredibly ugly and the technical chart is broken, why are BlackRock and Vanguard holding almost 30% of the company between them?
That is the signal through the noise right there. The smart money isn't fleeing. They likely view MRA not as a quarterly momentum trade, but as a multi-year, long-term infrastructure play. They know that power generation and digital assets are fundamentally the future, and they are willing to wait out the current volatility. They are thinking in decades, not days.
That is reassuring if you are a long-term holder. But then we have to look at the insiders, the people who actually work in the building.
This is slightly less reassuring. Insider ownership is very small, only about 2.09%. And recently, we have seen some selling. CEO Fred Thiel sold about 27,000 shares in February 2026 at around $7.66.
Oof, selling at the absolute lows. That does not inspire confidence. If the captain is visibly putting on a life jacket, the passengers are naturally going to get nervous.
It looks really bad optically. Now, to be fair, the source material explicitly notes this follows tax-related dispositions. Executives very often have automated, pre-planned schedules to sell stock just to pay the taxes on their vested bonuses. It is likely just standard financial housekeeping.
But still, when the stock is down over 50% from its highs and the CEO is selling shares, retail investors notice. It feeds directly into that bearish narrative.
It absolutely does. But the key takeaway here is the overall concentration. The top 25 shareholders own nearly 55% of the entire company. Control is incredibly tight. This isn't a loose ship day traded by millions of people. It is being held securely by major, well-capitalized players who have the capacity to hold through the storm. Chapter 6. Risk Assessment.
We have been dancing around the risks for the last half hour. But now we need to look them dead in the eye. What could actually kill this company, or at least what could completely derail this AI pivot?
The biggest immediate threat is geopolitical, specifically the tariff situation.
Ah, yes, the 2025 tariffs. Let's break those down because they are brutal.
This is a major headwind that hit the entire mining industry like a freight train. The U.S. imposed severe duties on hardware coming from Southeast Asia at 21.6% and from China at a whopping 57.6%.
A 57% tax on hardware. That is devastating for a hardware-intensive business.
It is effectively a hardware tax. Think about it. MARA's entire business model relies on buying thousands of high-performance mining rigs and cutting-edge AI servers. Suddenly, the base cost to deploy those machines in the United States just skyrocketed. If you buy $1 million of equipment from China, you immediately owe the U.S. government over $500,000 in taxes before you even plug it in.
So what does that do to the broader industry?
It threatens what analysts are calling a hash power exodus. If it costs 50% more to build a data center in Texas than it does in Alberta, Canada, or somewhere in Russia, companies are naturally going to move their operations. MARA is desperately trying to build in the U.S., so this hits them directly in the wallet. It makes their Made in America infrastructure strategy so much more expensive.
And then there's the macro picture. Inflation.
Right. Inflation is projected to tick up about 2%, partly because of these exact tariffs making goods more expensive. When inflation stays up, the Federal Reserve keeps interest rates high. And when interest rates are high, speculative assets like Bitcoin usually suffer because institutional money can just earn a safe 5% in a bank account risk-free.
So the macro environment is actively hostile. What about the operational risk? We talked about the pivot to AI. Is that as easy as just unplugging an ASIC miner and plugging in an NVIDIA GPU?
Not at all. That is the massive execution risk. Building a Bitcoin mining center is relatively simple. Structurally speaking, you basically just need massive power and big fans. Building an AI data center, you need intricate redundancy, you need specialized fiber optic connectivity, you need absolute 99.999% uptime guarantees because your clients are massive enterprise companies, not a decentralized network protocol.
Is the difference between running a storage warehouse and running a modern hospital.
That is a great analogy, and we honestly don't know yet if Mara can effectively act as a hospital administrator. They have to actually fill that massive 2.5 gigawatt capacity with paying, reliable AI clients. If they build it and nobody comes.
They are left with a lot of rapidly depreciating computers and a truly massive electric bill.
Exactly. Let's summarize the SWOT analysis quickly for the note takers listening.
Sure. Strength. The Treasury. 53,000 Bitcoin is a massive war chest that very few companies on Earth can match.
Weakness. Negative margins. They are losing significant money on day-to-day operations right now.
Opportunity. The AI pivot. If it works, they become a diversified utility giant powering the next generation of computing.
Threat. Regulation and tariffs. The government is actively making it harder and more expensive to do business in the U.S. Chapter 7. Conclusion.
We have unpacked a lot of dense material today. We have looked at the massive scale, the confusing financials, the smart money ownership, and the really scary tariffs. So let's bring it all home. What is the synthesis here?
Let's start with the bull case. If you are an optimist, MARA is purely a digital energy play. You have to stop looking at them as a Bitcoin miner and start looking at them as a next-generation power company with 1.8 gigawatts of capacity in a world that is absolutely starving for power.
And statistically, based on the models, the stock is cheap. If you trust the math, the intrinsic value is $3, and you can buy it today for $8.
Plus, that surprising dividend shows they are at least trying to be disciplined and return value to shareholders while they navigate the pivot.
And the bear case.
The bear case is brutally simple. The bleeding hasn't stopped. A $1.7 billion quarterly loss is incredibly hard to ignore, even with accounting caveats. Their business model is still fundamentally tethered to Bitcoin's extreme price volatility, and those new tariffs have permanently raised the baseline cost of doing business in America.
So after all this research, what is the final verdict?
The outlook from the report is neutral to cautiously optimistic.
Talk to me about that. Why neutral and not just a screaming buy if it's so cheap?
It really comes down to the margin of safety. MRA has highly tangible physical assets, power plants, substations, data centers, and a massive pile of highly liquid Bitcoin. Even if the AI pivot is slow or completely fails, those assets have a hard floor value. The company isn't going to zero tomorrow.
So if you strongly believe Bitcoin goes up long term,
then MRA is a leveraged play on that exact belief. You get the Bitcoin price appreciation plus the operational leverage of their mining scale.
and if you believe in the AI revolution.
MRA is a picks and shovels infrastructure play. It is a way to bet on AI without having to pick a specific software winner like OpenAI or Anthropic. You are just betting on the raw electricity that powers the AI.
And this is a huge, but we have to stress, the risk profile here requires extreme tolerance. This is a very high beta stock. It is going to swing wildly. It is absolutely not for the faint of heart.
It's definitely not a stock for your set it and forget it retirement fund. But, you know, this whole deep dive really has me thinking about something bigger. We used to think of currency strictly as gold. Then we evolved and thought of it as paper fiat. Then we moved to digital code, like Bitcoin. But MARA is betting their entire future on something even more fundamental than all of those. They are betting that the ultimate currency of the future isn't even Bitcoin, it's the energy itself.
Energy is the only true universal currency. You literally need it for everything.
Exactly. If they can figure out how to perfectly arbitrage energy into intelligence, taking a raw, cheap electron in Texas and turning it into a high-value AI thought or a Bitcoin, does the US dollar price of Bitcoin even matter in 10 years? Or will we all just be trading in kilowatt hours of compute?
That is a fascinating philosophical thought to end on. If energy is the ultimate constraint, then the power grid basically becomes the new central bank.
Something to really chew on as you watch the markets this week.
Indeed.
That wraps up our deep dive on MRO holdings. Just a quick reminder, this analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
Stay curious, everyone.
We'll see you next time.